Wednesday, March 4th, 2:21 p.m. New York time. Welcome back, investors, doing Wall Street's money. Got to show you a trade idea I took using options on the S&P 500. Here's a bullish option trade, swing trade. Placed it yesterday near the close of day and closed it this morning during morning trading hours for profits. That's a lot of information. The S&P 500 is a stock index. Liquidity spreads are outstanding. It meets my requirements for trading options. Options are a derivative, just like assurance in the futures market. So the trade idea I had was directional. I bought options, had to pay for them. Majority of my trades are for credit. I sell options, collect income, like an insurance company that sells premiums to buyers for those insurance policies. This swing trade had options that expire this Friday. My game plan was to be out of it before Friday, but I bought Friday, so I have several days to be in the position if I needed to be in more than one day, more than 2 days. I paid extra because I had a few extra days. Yep, the longer the duration, the more you pay. These options scheduled to expire this Friday again. That's not that far away, so it wasn't a big expense. We're looking here at 3 daily charts. The S&P 500. The far right, it trades in the futures market, which is a derivatives market. The symbol is ES. The middle chart is the cash index, the SPX. And the left is the stock ETF, SPY. So again, on the far right, that's a futures, ES. It trades more hours, has different policies, how it's priced, and margins required. It has options on it. They're different than options on the stock market. Yes, I've done it overnight. But regular trading hours, I use the options on the equity, cash, stock ETF. So the middle one, that stock ETF on the far right, that SPY, that mirrors the middle one, SPX. SPX, you cannot trade that. It's an index, but you can't trade it. So you use the stock ETF on the far left, SPY. But the good thing is SPX does have options on it, which is derivative. You can trade those. So again, these 3 financial instruments, they each have options on them. That being said, see these charts I have, daily charts, they look similar. So again, when the market closes on the equity market for the cash index in the middle and the far left, the futures continues trading for additional time. Look at the low of last year. The low of this year. I have it labeled there. The yellow horizontal line. That was yesterday. And today, we're currently trading higher high, higher low than from yesterday. And you notice on the far right, the ES, it was a red candle near the low of the year. And the SPX was a green candle. Big difference is, again, the ES has longer trading hours, but similar patterns. So yesterday, I was bullish on the S&P 500. I shared that in a video, top down, explaining multiple time frames, my setups, my singles, and entries. And I was thinking again, we're going to have a reversal occur. And it did. It occurred yesterday. Again, I posted that. It's online before the market opened yesterday. So I sat on my hands and waited for the single. It came in the afternoon. That's why I didn't take it in the morning. And you can see in the morning, afternoon, huge wick on the bottom here, huge wick on the bottom there. And the options I traded were here on the SPY. Directional. That means I need to stock the underlining, stock the futures to go higher with the option. And again, we're going to go to the option chain now. to show you that. So yesterday's big sell-off in the morning, huge dump, and a reversal. Well, I'm going to show you here on the SPX for some 30 minutes. Here's 5 days. This is today. Again, each of these 30 minutes. And yesterday, when we opened, we gapped down, sold off, panic selling, huge panic selling, inside candle, reversal. And I did my trade in this time frame yesterday. And I closed it here in the morning today for about 40 something percent gain. Yeah, one day. That was nice. Now let me show you this on the 15-minute chart. Same thing, 5 days, 15 minutes. Yesterday's open, gap down. Again, we closed here yesterday. We gapped yesterday morning open. Panic selling, more panic selling. Inside candles, reversal. Nice. That was the high of the open. We broke above it. Strength. Bullish bias, me here. Consolidation. And I put the trade on. Put this back on the daily. Let's go actually to the SPX, sorry, SPY. 6 months to show you. Put it on the year. So when I say out of the money, I'm referring to prices that are higher here. Again, the stock price right now, you can see up here, top left, 686.64. I purchase out of the money strikes. That means strikes that are out of the money above it. Call options, buying call options are bullish, just like buying the stock. If I was due in the money, it would have been strikes below the stock price. I bought them out of the money. They're less expensive, and I need the stock to move fast in my favor for that value to go higher. Plus, I only had a few days. Let's go to the option trade now. Here we are on the stock symbol SPY. There's the price, bid and ask, about a penny wide. Open up the option chain. The contracts I did, again, are the ones that expire this Friday. This Friday is 6 March. That's the contract, 6 March. Now it says 2 days left in parentheses, where yesterday it was 3 days left. So again, it changes from 3 yesterday, and today's Tuesday. Today's 2 days, because today's Wednesday, so 2 more days. Thursday, Friday, 2 more days. And again, the contract I bought was on the calls. Here's the call side. The strikes, all the way down here. And the strike I did, keep going, keep going. Oops. 696. When I bought these yesterday, I bought about $21, and I sold them this morning at $30. Yep, about $9 and some change per contract. It was a swing trade for 2 days. Again, I'm not marrying this position. I'm not buying contracts that are going to be 90 days, 3 years out. No, there's a swing trade with options this week. And thank goodness. Let's put this now on the 15-minute, or let's put it back on the 30-minute. Here we're on the 30-minute. Bought them here yesterday. Huge impulse move up. And I made my money. Nearly 50% with that price chart I do. The point is, this may roll over today, tomorrow. I was good money management. I was happy with my return. Nearly, was it 43% I made gains? Yeah. So where do you make that with a money market, with a CD? How long would you have to invest in that? You're lucky if you make even 10% per year on a CD money market. Let's go to the option chain. So because I was bullish on the call options, I bought out of money strikes. So again, here's the stock, 686. 686. So when it's at the money, it means it's the same strike as the underlining. 686, 686. That's at the money strike. Higher strikes are out of the money. And like I mentioned, I did the 696 out of the money. I showed you on the chart. Now you're seeing here. So big difference. Now, if I want to buy it, it's 27 bucks. First, if I do at the money, Here's the at the money. Cost $434. Yep. These are priced just like you see. 4.37, $437. These contracts represent 100 shares. Do the math, 100 times that price, $436, $436. Yep. So gallon here, when I did the $21, it says 21 cents, but again, times 100 shares. Why 100 shares? Because the contract is equivalent to 100 shares. Multiply it, 100 shares there. So now it's $27 for the 100 shares if you're bullish. Well, just think if I want to put a bearish trade on right now, if I'm bearish, I go here on the puts, the inverse. But again, let's just focus on the bullish, what I did here. See this contract, 696, 26 on the bid, 27 on the ask. 1 penny wide, that's fantastic. Very little slippage, almost no slippage. Again, the stock, SPY, stock ETF, look at the bid and ask, 1 penny wide. That's outstanding. If it goes wider, you're overpaying. So this worked out fine. The liquidity and spread are fantastic on this. Why did I take the trade? Well, again, using charting. Looking at multiple charts, multiple time frames, bullish bias. I like the setup. Took it. Money management. Now, sitting on hands before I take another one. I may not see a single today or tomorrow. But why would I want to buy options that are going to expire weeks or months away in something so volatile right now? Let's go put this on the index. Daily chart, 6 major indexes. This is part of the trading methodology I apply with options. What I'm doing directional. Again, this was a directional trade, buying calls, options on the S&P 500, looking for the S&P 500 go higher. And it did. Worked out very nice. It's not sustainable. So I'm looking for a short-term trade. This was a swing trade. It was 2 days. Now, if it does continue going higher today, tomorrow, then the value of that option only has a few days left. Why would I want to take that risk? Yeah, that what I paid for melts away if the stock goes in consolidation or goes down. The return is fantastic. It worked well. Thank you as always, spending just a little time with me. That's it for the video. Thanks for watching.